Yesterday we had an incredibly interesting video, and we're going to have another pretty interesting video again today. But yesterday was about my conversations with my clients who were pushing me quite hard. We went in full deep macro analysis with lots of data and facts. So if you want to get that macro analysis and why we stand where we stand, definitely watch yesterday's video. Different format than typical. But let's get into today's video. Focus on the interesting data we saw today. We saw growth tech lead. We saw an interesting rally at the beginning of the day. We saw GameStop fly out of nowhere. So is today just a GameStop day and we just had a really weird type of day? I don't necessarily think so. I think today was actually a quite important day for things like innovation, growth tech. And I don't want to be somebody who, is just blindly following these tech companies. I do my homework and I don't buy all of them. I have certain tech companies I like. Jumia, for example. People were concerned about valuations previously when companies were trading at 100 times revenue. Jumia, based on last quarter's revenue, not forward-looking revenue, is trading at roughly 2 times revenue. This is the largest online marketplace in all of Africa, and it's multinational in Africa. Nigeria's economy is actually expected to grow significantly this year, and the IMF recently increased their expectations for that economy. The Nigerian economy is very much tied to the price of oil. We all know what's happening there. So this is a company I think is very well priced, very sound fundamentally. Everyone in Nigeria knows about it. If you have a Nigerian taxi driver or an Uber driver, I've had 2 or 3, and I've asked them. They all are familiar with Jumia. Other people from Africa I've asked about, they are familiar. Anyone in Nigeria, I guarantee you, if you meet someone who's actually from Nigeria, they will be familiar with Jumia, and they will say it's basically everything. This company is roughly $500 million. $500 million. It got up to $60 a share. It's now down to $5. Obviously, you don't want to go to past prices to compare to future prices. You want to compare it based more on fundamentals. But just for a little bit of a scope of a situation, we made a video about this stock at $2.83 a share. It's very early on in this channel. It's in a playlist. You can find it. I view it as a value stock, but it has tremendous growth potential. And that's a stock that's up today. A lot of other stocks that I feel similarly about, that I have built a case around, I think are doing well today, and I think are justified to do well today and are very well priced. Many of them are significantly below their March 2020 lows. And the funny thing about the March 2020 lows in these stocks is these stocks, actually a few days before the March 2020 lows, began to tick up. They did not bottom on March 23rd with the rest of the stocks. They bottomed March 20th, March 19th, roughly around that range. So I'm not saying right now this pullback is very comparable or the same, just totally parallel to March 2020, but I do think there are a lot of similarities. Let's get into the other stuff. I made my case. I like my growth tech right now at these prices. I didn't previously. I like it now. If in well-chosen names with the decent time horizon, if we're not worrying about tomorrow, if we're, worrying about, from now until the end of the year, longer than that, whatever it is, if we're willing to buy something and settle down, I think this is a pretty good opportunity to make purchases in that space. If you have done the homework and aren't buying a ridiculous stock that is probably going to zero, et cetera, et cetera, et cetera. Let's talk about more things that happened today. Affirm, worse or better loss than expected. The street was expecting 51 cents a share. They got 17 cents a share loss. That is significant. What is Affirm? It's a what's it called? Buy now, pay later company. If they are losing less money than expected, and they're in growth mode, so they're not trying to give capital to shareholders. If they're losing significantly less money than expected, that's a big miss by analysts. And they're so consumer focused, I think it's safe to glean from that insight that the consumer is stronger and is paying their debts with more strength than the analysts expect. Another thing, Goldman Sachs, I saw either revised their forecast I believe they revised their forecast. They said high yield was likely to have a default rate going from 4% to 1.9%. If it wasn't a revised something, it was a comparison of 4% and 1.9%. High yield, the highest risk debt in the market on aggregate, not investment grade debt. High yield debt is going to have a default rate of 1.9%, their forecast. If that's the case, we have to take 08, 09 situation stuff off the table, because that's what that whole situation was about. It was all about default. It was default, mispricing risk, etc. Apparently, the government fixed whatever could allow that to happen. You can question Goldman Sachs if you would like. They have been quite bearish recently in some departments, I suppose. Either way, they're putting out 1.9% default rate expectations for high yield, which is not very high, okay? Especially because high yield means high yield. They offer the best returns, adjusting for that risk of being, less than investment grade. So 0809 off the table. Last night, we're talking about it today. Finally, Powell is currently speaking. I'm not watching it. I'm going to watch it. Markets are spilling. Why are markets spilling? He is saying that a soft landing is out of his control. Of course it is. The economy can do a lot of things. I think everything the Fed is going to do has been priced in. I think it's been priced in too much in the stock market. I'm talking specifically about the bond market, which, as Bullard, the most hawkish member of the Fed, said just 2-3 weeks ago on CNBC. I'm happy to provide you with the link to this link. I put it on Twitter all the time. If you put it in the comment section below, saying that the bond market had priced in and adjusted for what the Fed's forecast for tightening was. And this wasn't a dovish member. This was the number one most hawkish member of the Fed saying that. So the market has done what the Fed expects. Then it becomes a question of the economy. Is the economy going to be strong or is it not? I think the Fed has actually done what it needs to do. Inflation has gone from 0.8% month on month, 1.2% month on month, 0.3% month on month. What we're waiting to adjust, and this is what I think is the crux and the accuracy of the statement. I'm not saying his statement was inaccurate. I think his statement's inaccurate. But here's what he means. He's talking about the supply chain. He's talking about the China lockdowns. Are those going to abate? Is the United States going to get its situation under control? Are oil prices going to come down? We don't have to worry about the Fed. Forget the money printing. They're not printing money anymore. That's taken off the table. Let's see what happens with the supply chain. My assumption is China comes back online. Prices are kind of pulling back. Of course, it's not perfect. I'm not saying inflation's over or anything. But I think the possibility we get to not inflation, but inflated. Prices are inflated. They are higher than they were 2 years ago. Okay, that's fine. As long as they're not still going up, we can live. The consumer's strong. A firm is beating expectations and rallying. That's good. I think things can be okay. So let's see what happens with the supply chain. The consumer seems to be strong. We're at 0.3% month-on-month inflation. That's 3.6% annualized, and that's decreasing. If we can get a decrease from 0.3% to 0, ideally, then we no longer have inflation. Month on month, it has come down. Yes, it has gone up year on year, but that's looking in the past. We're looking to see how is it translating to right now, today to tomorrow. Is tomorrow, we're going to say inflation is flat from yesterday? Yes. If so, that, in my opinion, is very good. Then we are no longer experiencing inflation. We have inflated. And I think that's a good first step. I highly doubt that prices are going to come down. I don't even know if we want that because wages are up. If we want wages, that just doesn't seem good to me. I mean, companies' earnings are up, so let's just chill with inflated, right? I think that's going to be okay. Ultimately, I think the market is being incredibly negative right now, and it's built on itself, and there's just a downward spiral. The fundamentals, in my opinion, do not support, and if you want deeper analysis on the fundamentals, please watch yesterday's video. I went over all my conversations with my clients. We really tried to get to the bottom of things, and my conclusion is the fundamentals are good. The market is doing its thing. It is puking, being emotional, panicking, whatever you want to call it. Something is happening with the market's mentality. But the fundamentals ultimately drive things. If you've been watching this channel for a long time, you've experienced the energy volatility when Omicron hit, when there was another wave. These kinds of things sent energy stocks down significantly for, a couple weeks or a couple months, and then all of a sudden we were back at new highs. So I'm not saying we're going to get to new highs. I think new highs is not warranted. I think new highs were too high, particularly, just they were too high. Okay, I'm not saying we get to new highs. What I'm saying is market stabilization should occur, and there are many stocks that are well priced, and they should probably be more fairly priced, and they should stabilize and see some rally, and the rest of the market can chill, chop around, etc., etc., etc. It doesn't need to keep bombing down. I don't think that makes sense when the fundamentals are strong. So, and we're getting close to historic PEs, so we'll see what happens. That's today's video, and until next time, peace out.